Let's have a look now at the Cartesian Capital Local Equity Fund with Anthea Gardner of Cartesian Capital. You like Capitec, you like, what else do you like? There's a couple of other things here. Let me just look in the list here, Anthea. Sorry, I'm disorganised. Grand Parade, things like that. There are pockets of investment opportunities on a very elevated market, apparently.
Yeah, well, thanks for having me, first of all. Yes, I guess the last time I spoke to you, we were talking about how we were expecting a market correction. That was about 2 weeks ago, and we've certainly seen the market come off significantly since then, enough to make us nervous. But I think what we've got now is probably good opportunities, you know, so there's a lot of talk about how South Africa's struggling. Yesterday, our GDP got revised down by the IMF to 1.4%. So one of my kind of favorite rand hedge stocks is Steinhoff, really. It's such a good play on an offshore market. They're now 90% of their revenue is from the UK and Europe. Good cash generator, the second largest retailer after IKEA, furniture retailer after IKEA, and doing well. They're a good cash generating business. Their dividend was increased by 88% recently in the last results presentation. So there's a lot of good news, and clearly Marcus Joost is quite positive on Europe. I mean, his returns were up on the operating profit level were up 52% when all of us are worried about Europe. So quite frankly, I think he's doing okay.
It's interesting you mentioned the international exposure, because another company you like is Capitec, which, if I'm not mistaken, is all South African, but and has gone through its issues as well with regard to unsecured lending.
You've definitely got me there. But I do like Capitec. You know, when African Bank failed, Capitec was down 13%, I think it was 13%, but it's now up 18% since kind of from its trough. So it has recovered, and I've always liked the story, and I was really nervous with the African Bank failure because we were all around when Lehman happened, and the contagion was huge. There was big issues, banks getting worried, liquidity issues. But Capitec's a different model. You know, they're more of a fee-based model. And the other thing about Capitec, and besides the fact that they just keep beating every time they beat consensus, so you're looking at a share that keeps going up. The other thing about Capitec is that they're quite cautious, and as I said, a lot of their money comes from fee transactions and not the unsecured lending, which was the African Bank issue. One of the things that Capitec did kind of at their last results was they mentioned that they'd increased kind of their cover ratio for non-performing loans from 170% to 200%. So they're being conservative. There's no worry that the impairments are going to increase, and if they do, well, we're watching carefully, you know. Of course, the other thing about Capitec is that they're looking to release a credit card in September next year. And what we've seen from Capitec, they currently have 2.5 million clients, and they're growing that by up to 100,000 clients a month. And the interesting thing is that they're taking market share from the bigger guys, so from the big four, you know, the First Rands and Absas. And so what's happening, I think, is that clients and consumers like myself who are looking at Capitec and going, well, I want cheaper banking. I'm cutting costs at every corner. Capitec offers that. They offer cheaper banking. So they're not taking African banks' unsecured lending clients. They really are eating into the big four's lunch.
Exactly.
Yeah.
Mark, from your perspective, are you happy with the companies that have been chosen, or picking the brains on the...
Yeah, we've got a few others here, I think, that we haven't addressed. It's interesting, I've been around long enough to remember when exactly what you were saying about Capitec was being said about Able as well, and Kekuleka Lano. But what I find quite interesting is the word rand hedge, and particularly with respect to Steinhoff. That presupposes that it's a one-way bet, that, you know, the rand's weak. What happens in a scenario where the rand goes from 14 to the euro to 10 or 11? It's not out of the question. We've been there before. No,
it certainly isn't out of the question, but I think in the short to medium term, it is almost a one-way bet. You know, we've got twin deficits, we've current account deficits, we've got savings deficits, we've got mining strikes, we've got low GDP, we've got a lot of things against us. And so does Europe, fair enough. And then at the same time, we're sitting, the SARB is sitting in such a contentious position because it's stuck between raising interest rates to keep inflation down, which is its mandate, and not raising interest rates because it'll subdue the growth of the country, which we clearly need. So I'm afraid in the short term, I think the rand probably is not going to strengthen too much. It is my job, though, to watch that share and to watch what happens. And so if I think things change, then believe me, I'll change my mind very quickly.
Anthea, in 3 minutes' time, the US Federal Reserve's minutes from their last meeting will be released. What do you think about that? Do you think the market is in the mood to say, even if it's good, we're going to sell it, even if it's bad, we're going to sell it, because there's been a certain shift in psychology?
There has indeed been a shift in psychology, Lindsay. I think for the risk premium that you're paying in the equity market, in developed markets, I don't think you're getting enough out of it. So I've recently been in a conference where some of the top chief economists of the world have been saying that in equities, you're looking for a 2% equity premium over fixed income markets. And is that enough to justify buying equities? I don't know. That's a call, I guess, that we'll see happen. It all feels a bit nervous. And then, of course, with the Fed talking about raising interest rates, I don't think that the US Fed would raise interest rates without taking cognizance of what's happening in Europe. So I suspect they're going to delay this as long as they possibly can. At some stage, they're going to have to normalize. But for now, maybe not.
And maybe that has a benefit for emerging markets like SA.
Maybe.
Exactly.
Hopefully.
Yes, indeed. Anthea, thank you so much for joining us today.